Mr. Saurav Mukherjee. Sir, we are very excited and honored to have you. Someone who does not need any introduction and has many fans in the audience, including myself. But still, let me get into the details. Mr. Saurav Mukherjee is the founder and chief investment officer of Marcellus Investment Managers. Prior to setting up Marcellus, he was the CEO of Ambit Capital. He was rated as the leading equity strategist consecutively for 3 years, 15, 16, and 17 by Asia Money polls. He is also the founding director of the Association of Portfolio Managers in India. He has written many best-selling books, one of them being Coffee Can Investing, insights from which we will be discussing today. Please welcome Mr. Saurav Mukherjee with a huge round of applause.
Thank you, folks. Thank you very much. Thank you. Thank you for inviting me.
We would now like to welcome Professor M. Jaidev. He is a distinguished member in the finance and accounting area of IIM Bangalore. He is a PhD from Osmania University and associate member of the Indian Institute of Bankers. He is a banking and risk management expert and is a member of the board of multiple companies, including BGSE Financial, a company promoted by Bangalore Stock Exchange. Please welcome Professor Jaidev with a huge round of applause. Now let me hand it over to the professor to commence the discussion.
Good morning, Saurabh. Good morning to all. Welcome to this session, and very interesting because investment and stock market is always interesting subject, and especially the students of B school, they have multiple way they are going to participate in the market. It may be taking their own positions, or it may be on behalf of the mutual funds and other investors, or they may be taking the role of the equity valuers and making some recommendations, and many other opportunities are available for them to lead this subject. So very nice to know about your contribution. I have seen it a couple of times, and I thought I am meeting you here on this session, but then they have given in the fine print at bottom line that you are joining on the online, and I have to be here in physical presence, so they can dictate, because our students, they can dictate the faculty to be here. Fine. So thank you.
Thank you for inviting me, and apologies for not being there.
No problem. I can understand, and it is very good also because effective cost, time effective, because Sunday spending a time is entire Sunday will be used. So, so coming to this topic, what is that? Just what is your theme of this book, and can you explain, because our guys are reading so many things about efficient market efficiency, and so on, so forth, and all those things, and various types of the investment strategies also. So what is your theme of this coffee can investing, and how do you link it with the established theories what we teach in the classroom here?
So I have to be honest, Professor Jaidev, there is very little in coffee can investing which is linked to my own education. I think conventional finance theory is very good to study in college. It gives you a understanding of how theory works, but very little of it actually works in the real world. So let me just take it step by step. So 2008 is when my colleagues and I migrated to India, and our earliest understanding of why efficient market theory breaks down utterly in India is the first sort of 2 to 3 years where we spent understanding how leading companies in our country cook their books, right? So if you think about it, right, if accounts are if the published financial statements are not a true picture, don't provide a true picture of the underlying state of the company, obviously the share price will not be a fair reflection of the company. So the first 2 years was really spent understanding accounting fraud in India, and why for many prominent companies, their published financial statements are actually not a don't provide a true picture of the underlying business. So just to sort of use broad approximations, I would say 40% of the BSE 500, the accounts don't actually give you a true picture of the underlying business. So by around 2011, Professor Jaidev, we realized that basically out of the BSE 500, only 300 are really relevant, right? Then 2011, 12, 13, 14, I met those 300 companies one by one, and I realized that the vast majority of them, whilst these 300 were honest, they are still honest companies, the vast majority of them are incompetent in allocating capital. And using finance theory, the simplest way to understand a company's competence or lack thereof in allocating capital is to look at the return on capital employed. So if you look at the Indian stock market, you will see 90% of companies struggle to generate a ROCE above their cost of capital, right? So if 90% of companies can't generate ROCE above their cost of capital, necessarily you screen out 90% of the stock market, right? You're thus left with barely 50 companies worth looking at in India. And 2014, I was thinking about how do you actually make money out of these 50 companies? How can you create portfolios, wealth, compounding out of the 50, when a friend of mine, another fund manager, legendary fund manager, Sanjay Bhattacharya, he told me to read a paper by Rob Kirby, right? So Rob Kirby was a fund manager in Capital. Unfortunately, he died a year before I published Coffee Can Investing. So Rob Kirby was for around 40 years a fund manager in Capital. And he went through a specific live episode which led him to write this famous paper. The famous paper was published in 1984. If anybody wants to read it, just go to Google, just put inside the Google search engine, Coffee Can Investing and Rob Kirby, and you'll find the paper. And the paper was the result of the following episode, the episode which changed Rob's approach to investing. So Rob used to manage money for Capital in Los Angeles through the 60s. Somewhere in 1973, a lady came to him, a client of his, a lady came to him and said, Rob, I'm very happy with the work you've done for me. I would like to also now hand over to you, not just my portfolio that you've been managing for a while. I'll also hand over to you my recently deceased husband's portfolio. And when Rob opened that husband's portfolio, Rob realized that the dead husband had outperformed him by a factor of 2. And the reason the dead husband had outperformed a successful fund manager like Kirby, Rob realized, was the husband would buy the same shares as Kirby at the same time that Kirby bought. So the husband would buy with Kirby, but the husband would never sell. And over time, because the husband let his positions run for longer, he outperformed Kirby by a factor of 2. And that led Rob to hit upon this style of investing, which is called Coffee Can Investing, which is buy a bunch of great companies and hold on to them for long periods of time. He called it Coffee Can because back in the Wild West, say 150 years ago, when America didn't have enough banks, Americans would buy their stocks and Americans would put their savings in coffee cans and seal the coffee can shut and put it underneath the pillow. And hence the term Coffee Can Investing. So the concept that I learned courtesy reading this paper in 2014 was, if you buy a bunch of great companies and hold on to them for a long period of time, you make a lot of money. But the question remained, how do your students, how do we identify great companies, right? I narrowed it down to 50, but how to create a portfolio of say 15 stocks, 15 rather than 50. And that's when in 2015, January or February that year, I was invited to a roundtable in Mumbai with 3 other fund managers. I think Forbes, the business magazine, hosted it. There was myself, Bharat Shahji, and I have to honestly admit, I can't remember the names of the other 2 fund managers, right? They were there, but they're sort of forgotten in the mists of time. Bharat Shahji said something in that roundtable, which sort of made a light bulb go off in my head. So we were discussing in the roundtable how to identify great companies, and Bharat Shahji said that, look, great companies distinguished. He said, any company, you just need 2 metrics to understand a company. One is ROCE, right? So ROCE, if ROCE doesn't exceed cost of capital, you can forget about that company, which is true for most companies in our country. So the first metric which defines a company is ROCE. And the second Bharat Shahji said, was revenue growth. And when he said these 2 things, right, a light bulb went off on my head. I went back to the office and I requested my colleagues to run a crunch, 10-year crunch. So I said, take rolling 10-year period, start in 1990, roll for 10 years, roll every 10 years. So 1990 to 2091 to 2001, 92 to 2002, so on and so forth. And look for just 2 things. I told my team, just look for 2 things. Look for companies which every single year in that 10-year period have an ROC greater than 15%, above cost of capital, that is. So look for ROC above 15. and look for revenue growth in double digits every year, 10 out of 10 years. So rolling 10-year periods, I think I remember we took 20 periods, each of which are a 10-year period. We were looking for companies which have ROCE greater than 15, rev growth greater than 10, and the results were outstanding. The results were stunning. To this day, they remain stunning. That was the foundation of Coffee Can investing. You follow this very simple method of investing in India, you compound at around 25%. So that became the basis of the book. It became the basis of Marcellus. It's an extremely simple insight. It gives you portfolios of 15 stocks. Typically, the top 4 stocks carry 40% of the portfolio. The top 10 stocks carry 80% of the portfolio, and you beat the Nifty by 7-8 percentage points with very little churn. And we do this for around 10,000 clients, for some American institutions, for the Indian Navy's pension fund. And we manage $1.7 billion following this philosophy.
Great to know about that. 2 parameters are very important, that is return on capital employed and revenue growth in identifying the undervalued companies. And I have a small doubt I'm getting, or a question, maybe a clarification, that why not many mutual funds are unable to generate a good amount of the risk-adjusted returns when these 2 parameters are very important, and are they not identifying the undervalued securities, or these undervalued securities are available only to, here we have a theme of India versus Bharat, is it available only for India but not to Bharat, for the larger people?
Right. So I think what's happened, right, and I sat on the SEBI Mutual Fund Advisory Committee for many, many years, and I sit on other committees, not on the Mutual Fund Committee anymore. I think what's happened the world over, but especially in India, is I think mutual fund regulation hasn't been able to adapt to how the efficient market theory has fallen apart. So let's step back and understand how efficient market theory has fallen apart. So somewhere around, our work suggests somewhere around 2002, 3, 4, right? What has started happening in India is the Indian stock market started polarizing radically around the turn of the century, Professor Jaidev. So 2002, 3, 4 is the best I can get it to. We'll publish a book next year with some exact dates and precise data. If you look at the 90s, say let's take the 90s, the top 30, perhaps even 35 firms would have driven 80% of the stock market returns through the 90s, right? So out of all the 6,000 companies listed in India, through the 90s, say around 30 to 40 companies would have driven 80% of the returns in the Indian stock market. In the first 10 years of the century, just 26 companies drove 80% of the returns of the stock market. Right? In the second 10 years of the century, 2010 to 20, just 16 companies, 16, drove 80% of the returns, right? Now, why are returns polarizing? Why is it that a handful of companies make 80% of the returns of the market? It's because technology and finance created huge changes around the turn of the century, right? Let's understand the technological changes first, right? So in a celebrated 1996 paper, right, a guy called Brian Arthur, right, it's an HBR paper, 1996, he identified, I think earlier than anybody else, that in a world where companies are increasingly characterized by technology, right, in a world where even banks or paint companies or pharmaceutical companies are increasingly characterized by R&D, intellectual property and technology, what you will get is increasing returns to scale, right? Because technology gives you almost infinite returns to scale, it creates a winner takes all paradigm, where in a certain industry, the winner will scoop away everything. The winner will pull away the entire industry's profits, right? And easy examples in the global context would be, say, Google in search, Microsoft in office software, right? In India, powerful examples would be what Asian Paints has done in paint over the last 40 years, what Pidilite has done in adhesives, what, say, a Bajaj Finance is increasingly doing in many aspects of lending, right? If you're a technology-driven company, you will pull away 70, 80, 90% of industry profits, and there won't be mean reversion. Efficient market theory and CAPM both fundamentally rely on mean reversion. Technology destroys that link between growth and mean reversion, right? So that's the first change. Technology changed the nature of corporate life, of profitability, and how growth drives profitability. And the second thing was access to low-cost money. right? If money becomes easily available, right? If there's a global glut of savings, as there is, has been for the last 20 years and will be for the much of the rest of our lifetime. If you have a global glut of savings and cost of capital drops, Professor Jade, then basically in a DCF, in a simple DCF calculation, your profits 10 years out, 20 years out, 30 years out are being NPV back at a lower discount rate, right? So the lower your cost of capital, the better your technological prowess, the lower your cost of capital, the higher the market values you. And this upward revision in valuation doesn't stop, which leads to polarization of returns, right? To the point where, as I was saying, last 10 years, just 16 companies have driven 80% of the market returns. However, mutual fund regulation doesn't sort of understand that. So mutual fund, for example, equity mutual funds can't take more than 10% in a single stock, right? By rule, they have to diversify. And if you see most equity mutual funds, Professor Jaidev, they'll have 40, 50, 60, 70, in some case 120 stocks, right? There simply aren't that many stocks in our country which actually make money. There simply aren't that many companies in the stock market which make money, which results in the findings that you read so often in the newspapers, that 80-90% of equity mutual funds fail to beat the benchmark. And that's why quite consciously we avoided becoming a mutual fund and chose to become a portfolio management services provider where you can build concentrated portfolios.
This is what exactly I had, a similar type of the apprehension, that whether the investment policy guidelines laid down by the regulator, is it an obstacle for the mutual fund managers to reach the highest level of the risk adjusted returns to the investors? You nicely very clarified about it. Maybe 16 to 20 way stocks are sufficient enough to have well diversified portfolio, and or maybe beating the market or beating the index, outperforming the index. That is really an interesting insight coming out of your practitioner perspective about investment market. I have one more question followed by this. Is it transaction cost is also too high in Indian market still, and which mutual funds are not able to make the highest returns, whereas the other type of the investment firms like you are able to generate such type of the returns?
So I think there's two types of transaction costs where we still have a problem in our country, and it's quite a big problem. And I'm pleasantly surprised you brought it up. I'm pleasantly surprised. I'm happy you brought it up, but I'm a little surprised most people don't seem to understand this. And I'm very pleased that you've been able to nail this point. So let's understand the two types of transaction costs which are still very high in India. First is brokerage itself, right? Brokerage, STT, capital gains tax, right? Long term or short term. That cocktail itself is pretty punchy, right? So that cocktail, brokerage plus STT plus CGT, easily ends up being 30 bips on a 0.3% of a trade, going in 0.3%, going out, coming out 0.3%. Second, sir, and the more powerful aspect of transaction costs, which are disappointingly high in India, is liquidity, price impact cost. Right. So every time we buy the stock, effectively our own trade is pushing the price up. Right. So if we want to buy the stock at rupees 100, we actually end up getting it at 100.50. So we pay 0.5% extra on even large cap stocks. On small caps, I just making me think about it on a Sunday, it makes me wince. Small caps easily 2% price impact cost. Right. So therefore, you have two challenges, therefore. Firstly, in small caps, you can't really manage a great deal of money. If you ask me, if you manage more than 2,000 crores in Indian small caps, it's a real struggle to deal with these two types of transaction costs, especially the price impact cost, right? Building even 100 crore position in a small cap stock is very hard work because liquidity is so scarce. But even in large caps, even in a large cap portfolio, what I've seen in India is as soon as your portfolio crosses 5 billion, which is 35,000 crores, as soon as your portfolio crosses 40,000 crores, you start struggling for liquidity. And then once you start struggling for liquidity, you start struggling for returns. So what the Indian market has shown very clearly is unless there's a dramatic improvement in liquidity, you cannot really manage more than $5 billion in India in equity mutual funds. But as you know, many mutual funds don't manage 5 billion. They manage almost 20 times that amount, which creates obvious challenges for them. vis-a-vis this issue. Now, one way to mitigate it is to do low churn. Right? If you churn less, right, we churn 10% a year. So a typical Marcellus stock stays with us for 8-9 years. If you churn less, you're mitigating the transaction liquidity cost. But most mutual funds astonishingly churn by 25%. So they are running lots of money. They're running hundreds of billions of dollars. They're doing it on high churn in a country where A, there's a liquidity problem, and B, the number of stocks which can make you money are no more than 20. And therefore, the mutual fund construct is actually quite counterproductive. To give credit where it's due, from a regulatory standpoint, what SEBI has tried to do is make it a retail product. It's not intended to be a product for high net worth people. The mutual fund is a retail product, and therefore the regulators view that at this stage of India's development, the retail product should be focused on mitigating risk rather than generating upside. And therefore, the mutual fund is a risk-focused rather than a return-focused investment paradigm.
Yeah, I have one question. Then I will request my students may be enthusiastic to ask some questions. One is, what do you think about, we see often this larger part of the investment advisory business, where stock recommendations are given, and even now current latest is a lot of robo advisors are coming, and they have been using various types of the techniques, maybe machine learning and other type of the techniques also in identifying the stocks and recommending it. What do you think about it? Are these recommendations are really relevant for the retail investors, or
So look, I think there's a lot to be said for everybody getting professional advice, right? I think for people in their 20s, 30s, 40s, it is important they hire an RIA, a registered investment advisor, and get a proper financial plan built. I have to confess, I do see too many people running around doing random savings. Some people are having a crack at crypto. Some other people have full-time office jobs, but they're day trading. A gentleman who comes to train me in yoga, he's also trading through the day. So there's a lot of random financial behavior in India. And I think that can be alleviated, that can be minimized by getting a professional advisor to give you a plan, right? Now, can you do financial planning? Can you or I get a financial plan from a robo-advisor? My reckoning is, provided our financial affairs are straightforward, yes, we can. There is no reason why. There's no reason why Saurabh Mukherjee's financial plan can't be done by a robo-advisor. And SEBI has been progressive in this regard. SEBI has given licenses to robo-advisors, as they have given RIA licenses to robo-advisors. And again, you've seen the same thing happening in the West. Betterment, Wealthfront in the West have done robo-advisory in RIA. I think that there is scope for that in India. And I think it is but inevitable we will see more financial advice being automated, more personal financial planning being automated. And indeed, Coffee Can Investing, I've given a couple of templates in the book, which the smart people and IIM Bangalore can automate and turn into a very profitable business. You don't have to give me any royalties for it. Just acknowledge that the template was taken from the book. But beyond us, leaving aside what we've written in Coffee Can Investing, more generally, I think there's immense need for affordable financial planning advice in the country. People don't take it. They end up with messed up investment portfolios, too much in high risk, low quality assets, too much in insurance policies. Again, a perverse thing I see in Indian families is they end up buying multiple life insurance policies, multiple general insurance policies. They buy insurance products which are as mutual funds masquerading as insurance products. There's a whole lot of nonsense out there, and good RIAs can help people minimize this sort of nonsense.
Yeah. Would you like to, anyone? Yes, please. That's right. Just let's give it.
Good morning, good afternoon, sir. So like you said that in Coffee Can Investing, we look for companies, we look over for companies for last 20 years who have given ROC of 15% and growth on ROC of 15% and growth in revenues in double digit. But if we see in past 20 years, there'll be like handful of companies who have actually outperformed the Sensex by maybe 5 to 8%. So in that case, how do you suggest mutual fund which have consistently performed for given a performance of 9 to 14%. So how do you suggest that Coffee Can is like better than mutual funds in that case?
Okay, so let's take it step by step. We'll look for in the book, in the Coffee Can investing construct in the book. And remember, the book is intended for the mass audience who will never be able to afford our services, right? Courtesy the regulator, we need the regulatory requirements for PMS scheme. We need at least 50 lakhs for a investor to sign up with us. And whether anybody likes it or not, 99% of Indians will never have enough money to sign up with us. And therefore, the book is intended for people who will never be able to afford our services. And in the book, we said 10 years, we need for a company to qualify. For a company to qualify for CCP, we need a decade of ROC greater than 15 and revenue growth greater than 10, right? Every single year. As you rightly said, around 15 to 20 companies will pass the filter, right? And if you put them, you buy them, whoever is out there is buying them, you make a good turn over the next 10 years. Now let's answer your question on mutual funds, right? The data is actually very clear. I've cited it in the book. For every 100 equity mutual funds in India, right? For every 100 equity mutual funds in India, 90 consistently underperform the benchmark. But there's an even more disastrous thing that happens out there. So let's take the last 5-year cycle. Typically in a 5-year cycle, out of 100 mutual funds, around 10, perhaps around 20 will give you top quartile returns, right? So last 5 years, 20 out of 100 will give you top quartile returns. Then when you roll the analysis forward the next 5 years, barely any out of those 20 will give you top quartile returns in the next 5 years. So the deeper issue is not underperformance in mutual funds. That's a well-known and well-publicized challenge. The even deeper issue is lack of in mutual fund returns, right? Lack of persistence means mutual funds who outperform in a 3 to 5 year period go on to underperform in the next 3 to 5 year period. So if anybody out there looks at the backward looking returns, and signs up, almost inevitably they're disappointed. And in my 14 years in India, I've only seen 3 mutual fund schemes, not fund houses. I've seen only 3 mutual fund schemes which have any persistence in their alpha, right? Remember, it's not alpha per se. We're looking for persistence in alpha. So persistence in alpha is rare. And to be fair to the mutual funds, it is very, very difficult to generate alpha in that paradigm. A, because you're managing vast sums of money, far more than can be actually managed sensibly in our country. Secondly, you're spreading your portfolio across 50, 60, 70 stocks. There simply aren't that many good companies in our country. And thirdly, the regulator is making you fragment the portfolio into small position sizing, which itself robs you of alpha. Right. So the result is that the regulator has created a paradigm which I think is fair for the retail investor, the small saver with say 1 or 2 lakhs, 3 lakhs, 5 lakhs to save per month. But for families who can afford it, the PMS paradigm works. And just to put it in context, when I migrated to this country in 2008, the PMS industry managed 8,000 crores back in 2008. The total industry managed 8,000 crores. Today, PMS assets are 4 lakh crores. And there's already 6 PMS providers in India who individually manage more than 10,000 crores. So the way the financial system will evolve is, for more affluent families, PMS will become the go-to product. And for the masses, 99% of Indians by number, mutual fund will and should stay their default savings vehicle. But as you can imagine, if 90% of equity mutual funds struggle to beat the benchmark, and repeatability of returns, repeatability of alpha is low, then obviously ETFs and index trackers will come and hammer the market share of actively managed mutual funds, as happened in America in the 1990s.
Yeah, I have seen raise hand. Yeah, please.
Hi. So you said there are 16 stocks more or less that are driving growth in the market. So do you think the regulator has to do something different now? Because if any of these fail, then we have a problem in our hands, don't we? There's so few companies driving the market.
That's the nature of economic growth, right? So one of the things to understand is economic growth the world over, right? Whether it's America when they industrialized say 100 years ago, or Japan when it industrialized after the Second World War, or Korea when it industrialized in my lifetime, economic development naturally favors the few over the many, right? So there is no instance in history of more than 20 to 30 companies dominating economic development. So America's golden age of economic development, which was 1880 to 1930, was dominated by around 20 to 30 families. Japan, even today, is dominated by 15 conglomerates. Korea, as you know, is dominated by 5. So economic development necessarily creates a very few large winners and lots of losers. So if you look at the Ministry of Corporate Affairs data, you see that in the last 5 years, every year 8 lakh companies are shutting down in India. So I think all of you, as you come into the broader corporate world, be very clear, right? The corporate world is about a few large, colossal winners, companies who go on to create hundreds of billions of dollars of wealth, and millions of losers, right? And that's the process of development. Economic development is the transference of resources, capital, labor, talent from the many to the few, right? The stock market naturally has to reflect that, right? Now that being said, the 16 companies that created 80% of the stock market wealth between 2010 and 2020 won't be the same 16 between 2020 and 2030. I doubt it'll actually be 16. I reckon 2020 to 2030 it'll be barely a dozen. There'll be a dozen companies that will drive 80% of stock market wealth creation between 2020 and 2030. But the 16 and the 12, there'll be around 50% overlap and 50% will be new names. Right? And our job, if you want to simplify it, our job becomes looking for those 6 to 7 companies that were either smaller companies in the preceding decade and have now come through to build mammoth scale, or companies who did poorly in the preceding decade and have got their house in order and will now have a tremendous 10 years. But the broader underlying point is that the few will drive wealth, right? The sort of socialist view of economic development, where everybody makes money and 1,000 flowers bloom, doesn't quite happen. It hasn't happened anywhere in the world.
Got it. Thank you.
Yeah.
Thank you, Saurabh. So I have a question, sir. As you said, ROC and the revenue growth is the 2 parameter, but I see important parameter is also their management. Like in your word, I say management should not be chore, right? So how do we identify that as a retail investor? For you might have a lot of data, you might have internal connection with the management, right? But for us, how do we find that the management is not sure, or they are very honest, they are capable for next 10 or 20 years to drive the company with certain ROCE?
So the simple thing to do, just sit and read annual reports, right? So you guys are students, you should have plenty of time. Hopefully your professors are giving you plenty of time. Just sit and read annual reports. Everything is in the annual report. A chore shouts out loudly in the annual report. The chore in fact shouts the loudest in the annual report, telling the whole world, look at me, I'm a thief, right? So you just have to read the annual report. So in all seriousness, just let's take these 3 simple aspects of the annual report, right? There's plenty of fun to be had. And if you guys want to read annual reports better, first 150 pages of diamonds in the dust. We've given you 10 case studies, real companies, real chori, and we've told you how we detected it. First 150 pages of diamonds in the dust. But this takes 3 simple aspects of detecting chori. And by the way, if you want to be an investor, reading annual reports for breakfast, lunch, and dinner is an essential trait, right? So the first is the audit disclaimer. The auditor typically tells you in his disclaimer that this guy is a crook, he's paying me loads of money, and that's why I'm signing off on his annual report, right? He pretty much tells you just have to read the disclaimer. And if you read lots of audit disclaimers, the ones where the auditor is telling you that, look, this guy is a crook, he's giving me loads of money, I need the money, so I'm signing off on the annual report, right? Just you spot it like that, right? You spot it like that. That's the first thing, right? Second is open the board of directors. If it's all stuffed with people from the same community, right? Basically golf club buddies, chacha, bhatija, uncle, all from the same community, that's the second red flag, right? And the third is go to the cash flow statement, right? If operating cash flow plus investing cash flow is always negative, right? CFO plus CFI below 0, year after year after year, you know something funny is going on. So 3 simple things to do. But more generally, if you want to be an investor, get into the hang of reading annual reports. Typically, if you spend an hour and a half reading an annual report, the chore will shout out in big bold letters, this is a crooked operation, invest at your own peril. And some of India's largest companies do so. It's just that nobody reads them. People then go and buy their shares, and then later on they complain, "Arey, regulator ne kuch nahi kiya." Because you won't read the annual report, you will be. And in fact, over the years, I've discussed it with investors. That we sit and discuss. I tell them, this is a chore you're putting your money in. He says, "हाँ है तो chore, but चल जाएगा शायद." And अगर फट गया, regulator will do something. And that's crazy. I mean, we can't bank on the regulator to save us, but historically that's been the attitude. Anything goes wrong, you go running to the government. Government, ji, bachao mere ko. I couldn't look after my clients' money.
Yeah.
Thank you.
Anybody? Okay. I have one question here. We have broader policy. The today theme is also reaching to Bharat, or there is a division between the India and Bharat. Very few people in the capital market and especially in the stock market investment, this is very much visible. Very few number of individuals are actively participated. Overall, if we take not even 6% of the household investments, or 6 to 7% of the household investments are in the equity shares and stock market participation. We have frequently talked about this to strengthen the financial intermediation and larger participation of the people in the capital market. Both government as well as SEBI and has coming out with a lot of policy and investor protection oriented measures and all these things. So now here is a conflict that whether if we are going for the retail investments and all that, retail investments are not generating the returns, what you are saying. And if we want to go for a high ticket investment like type of the firms like which are asking portfolio investments with 25 lakhs minimum investment or something like that one, or I think now the 50 lakhs is the minimum for portfolio investment, which earlier it was 25, now they made it increase to 50, I think. So this is how this trade-off, this type of the two conflicts can be addressed with that.
Don't mind my saying. So I think there's a lot of misunderstanding on this subject on the part of both the regulatory ecosystem and I think even on the part of our industry. So let's take the issue step by step, right? I think the best analysis that emerges in India on how India saves is typically the RBI's household finance survey, right? And if you look at the latest household finance committee survey, it says that 95% of Indian households' wealth. This is a balance sheet figure. This is not a flow figure. This is a stock figure. 95% of Indian households' wealth is in physical assets, right? Gold and real estate primarily. Mere 5% is in financial assets, right? Now, what I have seen in the last 5 years is every year, this 95 is dropping by 1%. So 95 becomes 94 in 1 year, 90 becomes 93 in 2 years, right? Now, what is the stock of Indian household wealth? Our estimate is the stock of Indian household wealth is roughly $10 trillion. So if you read Thomas Piketty's book Capital, he gives you the good ratio, which is household wealth for a country is typically 3.5 times national income, right? Income is a flow figure, wealth is a stock figure, and household wealth for India is roughly 3.5 times the national income, which is 3 trillion, multiply that 3.5, 10 trillion is our wealth. So 1% of 10 trillion, Professor Jaidev, means every year, we are putting roughly $100 billion into the financial system. We as households are investing roughly $100 billion every year in the financial system, general insurance, life insurance, mutual funds, PMS, direct stock investing. And the data actually validates that. If you look at data from AMFI, from IRDA, from RBI, from SEBI in the last 5 years, you can see every year roughly $80 to $100 billion of household savings is pouring into the financial system, right? The household finance savings rate, which percent is today 15%. It's trebled, right? So I don't think there can be concern that we're not saving enough. We're financializing at a rapid rate, far more rapid than anything seen anywhere else in the world. Now, let's come to the issue of, is everybody saving money or is it just a few rich people saving money, right? Remember, wealth in India is concentrated into the hands of 1 million people. So out of our 1.4 billion population, 1 million families basically control the country's wealth. The wealth itself is in the hands of very few people, and therefore we can't expect the other 1.39 billion people who barely have any money to save. In spite of that, what you see is startling. A decade ago, there were barely 15 million demat accounts in India. Today, there are over 100 million Demat accounts, right? There's this gentleman who comes in the morning to teach me yoga. He comes from a very humble background from a town in UP, right? He has a Demat account. Almost every day whilst I'm doing my asanas, he will ask me, kya lu, kya bechu, right? And my main job is to make him stop trading and start investing. Not only does he trade, his friends, other yoga teachers in UP, in Bihar trade, right? And if you go to small town India, people with very modest means are increasingly participating in the stock market, and they're not necessarily doing, satta or day trading. They're actually doing increasingly proper investing. That's why my books are getting translated into Hindi, and actually these books are selling more in Hindi than in English, which is itself fascinating. Right. So whether you look at number of mutual fund folios or you look at number of Demat accounts, both of them suggest a real spreading of investment activity into the deepest reaches of the country. In fact, our weekly newsletters get translated into Tamil. We don't translate it. A Tamil magazine called Nana and Vikatan translates our material into Tamil. If I miss out for a week, they go absolutely hyper. If 1 week I fail to send Nana and Vikatan an article, they go absolutely hyper. And when I've gone to Tamil Nadu, I've seen truck drivers, bus conductors, auto rickshaw drivers read Nana and Vikatan. Vikatan is a financial publication in Tamil Nadu, right? So there's enough democratization of savings, and therefore this concern that the masses are not saving enough, I think is a little misplaced. The bigger challenge in India is wealth itself is in the hands of very few people, and unless we create jobs for the masses, we can't miraculously expect 1.39 billion people to have disposable income to go and invest in equities. To the extent that technology has worked in India's favor, the rise of technology has already meant that in small town India, people with low incomes are increasingly participating in the financialization of wealth.
Yeah. What's your advice for people who are retiring with a good amount of the terminal benefits? They get gratuity and some type of the provident fund or other type of thing. Because now I am looking my selfish interest. Okay. So what is that advice you give that how to go for this investment? Because a lot of people, when they come out with huge money at the time of the retirement, and my observation is money evaporates very quickly from their hands, and within 4 to 5 years they are succumbed to this huge amount of the huge inflation pressure, and daily life will become very challenging. Though they had led, even I know a couple of people who have retired from senior positions in the banks like executive directors and such type of positions also. Within a few years, the money will be very limited in their hand.
So Professor Jaidev, I'm so glad you brought it up. So one of the reasons I wrote Coffee Can Investing with 2 colleagues, and one of the reasons I started Marcellus was around 6 years ago, I sat on my desk and I did a simple time value of money Excel spreadsheet, right? And what my very basic spreadsheet, and if you guys want, I can share it with you, all of you can play around with it. What it showed me is if you retire at 60 and say you live till 85, which is what most people in our strata, socioeconomic strata will do. Say you live for 25 years after retirement and you want a very middle class retirement, right? Maruti Swift Desire, holidays in Ooty, none of this Dubai or Toyota Corolla type retirement, right? Very middle class retirement, Swift Desire and holidays in Ooty. You will need 15 crores in financial assets at the point of retirement in today's money, right? And if you retire 10 years hence, usse time value of money se compound karo. Right, so 15 crores in today's money at the point of retirement, I thought about my friends, family and relatives. I said hardly any of them have it. They have all of these dud assets, which is dud assets is flats in Sarjapur or in Noida or in Gurgaon or in Salt Lake, useless things which will not even keep up with inflation. They have these LIC, Jeevan Sangharsh type policies, fixed deposits, these sorts of things which compound at rates lower than inflation, but actual solid financial assets, 15 crores at the point of retirement, I realized very few Indians have it. And that's when the realization dawned on me that as people realize this point, and they don't necessarily realize it from a spreadsheet, most of them realize it intuitively, saying, my God, I'm 50, I'll retire in 10 years, the clock is ticking on me and I don't have enough. I said people naturally will want to financialize, they'll want to get rid of their property and put money in the stock market. And that's why we set up Marcellus. Now, let's look at this problem, right? My dad is 75. It took me 3 years to persuade him. Sell your real estate, put it in Marcellus. because your real estate is compounding at 6%. He owned the flat for 40 years. This is the flat in outskirts of Delhi. 40-year gross compounding was 6%. Inflation for people like us in this audience is around 8%. If you want to get to 8 post-tax, you need at least 10% pre-tax. You're not going to get 10% pre-tax from real estate or FDs. And therefore, I finally managed to persuade my dad to sell the flat and put the money in Marcellus, right? Now, you might not want to put it in Marcellus, Professor Jaydev, you choose your equity instrument of choice. But even for retired people, right, as they head at the age of 60 or even at 70, you still have 15 years of compounding ahead of you. If you let inflation corrode your wealth, by the time you actually leave this world, or my parents leave this world, they'll be penniless. So my parents live in the UK, their pension scheme gives them 3%. Inflation in the UK is 10%. Imagine, right? 7% per annum, my parents' wealth is being blown apart. In 10 years, unless I persuade them even more to invest in equities, and my mom was calling me as you were speaking, so I'll have to do a financial session with my parents after this. Unless my parents invest more in equities, by the time they leave this world, they'll be bankrupt. And that's what's going to happen to lots of retired people in our country. Their wealth will evaporate long before they die, and it's a urgent situation which needs more retired people to come into the stock market.
Good. You have given a big target of 15 crores for all of us. Yeah, I think now we can stop here with this target. They need to go on, do a lot of hard work and earnings, right?
Thank you.
Thank you, Saurabh. Thank you very much. Yeah. Anything else? Would anyone would like to join? Anybody? Did I stop you anytime? My conversation stopped you? Okay. I think that our target is very challenging. They have become restless. Thank you very much.
Thank you, Saurabh. It was really an insightful discussion. We are very grateful. Thank you so much. A huge round of applause for Mr. Saurabh.
Yeah. I hope surely all of us will get an opportunity to have a coffee with you, whether coffee can investing or not. Thank you very much. Thanks, Saurabh.
We would now like to present a token of gratitude to Mr. Jaydev.
Oh, thank you. Should I hand over it to
Sir.
Saurabh? Okay.
Thank you, sir.
Right. Thank you.